everyone, and welcome to another episode of Five Questions with from List Self Storage, where we sit down with industry experts to get valuable insights into the self storage market. Today, I'm joined by Hunter Molnar of Storage Exchange, a data-driven brokerage platform with deep roots in self storage ownership and operations. Hunter, thanks for being here. Before we dive into our questions, can you tell us a bit about yourself and what sets Storage Exchange apart in the industry?
Yeah, thank you, Cindy. Super excited to be here. Really appreciate you having us on. Obviously, we love List. We use you guys constantly. Storage Exchange. So, I mean, the background of Storage Exchange, kind of my background as well. I think they really go hand in hand. I got my start in the self-storage world in 2014, 2015, working for a company called Red Dot Storage. They recently went through a very large disposition with SROA. I think everyone's kind of aware of that now, but it was great. It was super, storage in 2014, 2015 was awesome. You could actually buy at very favorable cap rates. There was a tons of new players coming into the space, tons of new capital. And I got my start on the acquisitions team working underneath Seth Bent. He had just raised about 20 million on his first fund, had about 20 properties, 20 employees. And, we were going out and buying self-storage assets in secondary and tertiary markets across the Midwest and Mid-Atlantic. Eventually started running the acquisitions team there right underneath Seth. And it kind of came pretty clear to us in like late 2018, 2019 that the space was getting very crowded. There was so much competition. And we were dealing with a ton of investment sales shops, a bunch of brokers in the industry who weren't necessarily focusing on the key investment making decisions and investment driving data points when looking at a sale, when looking at an acquisition. So feel like we were hitting our head against the wall. In a lot of our deals we were competing against on market. And we thought, hey, if we could go out to the marketplace, build an investment sales shop that utilizes our background as operators, that focuses on data, that underwrites deals the same way we underwrite deals when looking at investment committees, that we should be able to build a pretty powerful platform. And I think that story resonated with a bunch of buyers and a bunch of sellers. And we opened our doors in 2019, and it's been great. We have really deep rooted relationships, and we just try to stay focused on providing data that is based in reality, that is objective, and that is focused from our years as operators.
Appreciate that introduction. I think that leads right into that first question that we have here for you, which is, how has your previous expertise as an owner operator lend itself to the investment sales side of the industry?
Yeah, I mean, look, I think it's super important for investment sales folks to have this background as in the operations, because when these buyers come to the table, they're not just looking at a cap rate. They're not just thinking about, can I make this deal work on paper? Like, yeah, as a broker, you are the very tip of the iceberg in their ownership life cycle. They have to go then operate this thing. They have to return capital to investors, and eventually they need to either refi or go through some sort of sales process. So, the way we, like kind of mentioned previously, the way we look at these deals is the same exact approach, the same way we looked at these deals at Red Dot. We think about them with the same level of scrutiny, like a GP or outside capital would think about it. And we really focus in on the underwriting. We think it's critical to focus that your underwriting should be reflective of the operations and vice versa. We don't like to just build out pro formas that aren't based in reality. So when we think about these deals, we truly are thinking about, the operator, the buyer in mind, while at the same time, how do we maximize the proceeds from this for the seller? And I think that really does work hand in hand. I think a lot of folks really resonate with that.
Right. So building on that hands-on experience, let's talk about how you approach new opportunities. So what key items are you focused on when underwriting a new property?
Yeah. So we like to look at the whole story. right? I like to start 50,000 feet and work in. Who is the seller? Why are they selling? How have they been operating this property? And then, from there, because that's where you kind of figure out, well, what levers can a buyer pull, an investor pull to then grow property performance. Really focused on, next would be geography. As simple as what state is this in? What market is this in? Is this a primary, secondary, or tertiary market? Because again, if you can isolate the market, you figure out the property type. Is this class A, B? Is this going to be core plus, value add type deal? And you can start underwriting to those actual metrics. And then, really the meat of these deals come into is, yes, the in-place numbers matter a lot, especially with DSCR, with debt service coverage ratios being so difficult to overcome right now, with interest rates so high. The in-place numbers really do matter. But sometimes those can be skewed by poor expense loads. A lot of times first generation operators, they're going to have a very low expense load. So, we're looking at in-place numbers with market expense loads. Then you kind of go back to how are the current operations of the facility, use the current ops of the facility to understand what is my pro forma going to look like. And again, we're not just putting random growth metrics on our rates, growth metrics on occupancy. You have to, these data points matter, and they matter to investors. So having sound reasoning why we make certain decisions, it affects the valuation. So, that being said, we're really looking at a stabilized unlevered yield. So a stabilized cap rate in that year one, year two, and kind of comparing that, making sure it's still sound within year one, making sure you can still service your debt. Now, it seems like folks right now are really looking for more stabilized assets. The value add deals are just a lot tougher to come by right now. But they also want to, how do we figure out a way where we can return capital to our investors down the road?
Now, are there any red flags that immediately stand out to you when you're looking at these new deals?
Yeah, right away, before you even dive into the numbers, I think people are kind of afraid of properties where the general market's overbuilt. Supply is, everyone's talking about supply right now. There's been so much new supply that's come online. I know a bunch of different groups who are looking for markets with very high barriers to entry, whether those are mountain, resort type towns, municipalities where moratoriums are really prevalent, where they know it's going to be difficult or very expensive to build. If a new developer has to come in for $120 a foot, $150 a foot, an acquisition probably does make sense. And then physical quality of the asset, again, that's going to be tougher for insurance is through the roof right now. Okay? It's going to be harder to get really good insurance rates. It's going to be harder to get debt on the property. Certificate of occupancy lease up deals in the COVID years, great to come by if the assets make sense. Now, not so much. We've just recently sold a couple CO deals, but boy, those took some time. We had to find the right buyer. We had to see a little bit of a lease up trend. So yeah, supply, physical quality of assets, and very low occupancy is probably, I'd say, the three red flags people are looking at right now.
Gotcha. Now, what is your approach to giving a broker opinion of value?
Yeah, look, this all ties in. I think you're gonna hear some of the same stuff because it really is our approach to once you become an operator, it's hard to unclick that operator brain, right? So I like to articulate the deal story the same exact way I would articulate a deal story to a buyer. So when I'm telling, hey, seller, here is the valuation of your asset, but here's also why, right? So because of your current operations, because of the current cash flow, I think I'm going to be able to do X, Y, and Z, whatever that may be. It typically comes down to how do we grow rates or increase occupancy? And then what's a reasonable stabilized cap rate or the maximum stabilized cap rate I think the market could bear. And, we look at everything that I just stated above. We're looking at the market, we're looking at his in-place operations, and we're looking about how would a buyer see or perceive the way that they can grow value. And I think they resonate with that. We're not trying to. This kind of is a double-edged sword here. So we're not really trying to win listings with our BOV, right? Obviously, that is the goal. We are brokers. We get paid for selling deals, but we like to give a straightforward, honest approach of where we think the maximum is the market's going to bear, the maximum price we think it's going to trade, using objective data. And sometimes we lose listings because of that. But at the same time, I think we've won a lot of listings because of that too, right? I think people respect giving a straightforward and honest approach. And if we're not going to go out and buy listings and promise them the moon, and that bites us on a deal or two, we're more than comfortable with that.
Right. Yeah. Transparency.
Yeah.
So speaking of deal expectations, what are some key return metrics that buyers and sellers should be focused on when going through the acquisitions or disposition?
Yeah, I mean, right now, occupancy is so important. A lot of markets you look at and that we're underwriting, rates have clearly taken a hit. I mean, you can see it in the REIT reporting. Occupancy has taken a hit, especially for the non, super sophisticated and savvy operators. And it's just hard to compete right now with housing markets still in a lower demand, and so much demand for self-storage comes from housing. Occupancy has struggled. So when positioning yourself for a sale, I would definitely be focused on how do we have steady enough cash flow that can support someone coming on to service their debt and pay out preferred return. And then, I think it's critical to look at in-place NOI with a market-based expense load. Again, so many of these people have 18 to 20% expense loads on their current operations, and that's great for the seller. But when comparing apples to apples, when comparing NOI to NOI and cap rates, they're just going to fall short. So, sellers, when I'm a seller, I want the very top dollar, and that's exactly what you should go for. But if you're not thinking about it from a buyer's perspective, and how do they make a return, then it's going to be very hard for the bid-ask spread to align. But occupancy is huge right now. Rates are all over the place. I mean, the REITs with their dynamic pricing models, it can be really tough to keep up with them on rates. So actually, I was talking to a very savvy guy. I wasn't not going to throw his name out here, but he, the way they're thinking about rates is basically pegging them flat to the market average. And they know that when a new tenant comes in and occupancy comes in, that they're able to increase that tenant maybe 2, 3, 4 times before they move out. So those existing client rent increases, existing tenant rent increases are super important right now. And I think that is just a reflection of, let's get tenants in the door, and then let's hit them with a couple rate increases. They're going to move back out, and then let's get the next person in the door. And I think that's how some of the larger operators are thinking about occupancy and rates too.
So you definitely see a difference in how investors are prioritizing different metrics now compared to maybe, say, a year or two ago.
For sure. 100%. I think also there's been a lot in the last few years of groups who are syndicators and syndicating deals. And, as you know, that means basically they have their pool of capital, they line a deal up, and they say, who's in, who's out. And it can be they might own 50 properties, but it could be with 50 slightly different ownership groups. And the syndicator money seems to be very short-term money that are more IRR driven, and they're looking for these quick pops. It's really hard to handle or hit your quick pops if occupancy and rates are tough to grow, especially in a tough market right now. So I think that was going on over the last 12 to 18 months. It seems like those folks are winning a lot of deals because they're buying at really aggressive cap rates. But conversely, it seems like the REITs, the savvy operators, the operators with these large funds are remaining focused on cash on cash. So they're remaining focused on the long-term yield, long-term profitability of these assets, as opposed to quick, high growth, and then an exit.
Makes sense. So let's wrap this up with something we hear more and more in today's market. Why are sellers so inclined to shop deals off market instead of going through a listing process?
Yeah, I think a lot of it comes down to uncertainty in the market. These folks are highly motivated by price and maybe price only. And perhaps they're looking for, a little bit more of a discrete selling process. And when I say uncertainty, again, when interest rates are in the 3% range, deals are trading like crazy, you get 20, 30 bids on it. Of course, it makes sense to go through a listing process. As we know, buyers have pulled back some of their underwriting metrics a little bit, letting the market catch up. But maybe that's why they want to go off market. And then when I say motivated by price, people sell for all sorts of different reasons. And you might get the seller who says, well, yeah, I'll sell if you get me 10 million, but I'm not going to list it with you. However, it's so funny that buyers, we love doing deals off market, right? Because it is you versus the seller, and a buyer has a fiduciary responsibility to their investment group to get that deal for as low as price as possible. A broker, we have a fiduciary responsibility to the seller to get them the highest price possible. So I get it from both sides, right? I understand maybe you don't want to pay a broker. I think people kind of are over that. Like they don't really care too much about the fee, but it is funny because if you want the highest price the market to bear, you got to create the most competition as possible. And that's what we try to do. We try to price things accurately, give accurate data to create a bidding war, to create a process that actually gets the sellers the greatest net proceeds. So I think people struggle with that sometimes. And then there are folks that they want it to be discreet, which I can understand that. I mean, maybe it doesn't have anything to do with economics. Maybe they live in a small town and they would just prefer not word to get out. But I think if you're going to sell it, you can only sell a property once. So you might as well try to give it the best foot forward.
Absolutely. Well, that brings us to the conclusion of our segment. So big thank you, Hunter, for joining me and sharing your insights. If you'd like to connect with Hunter or learn more about Storage Exchange, you'll find the contact details on our screen. Hunter, before we wrap up, is there any news, upcoming projects, or updates you'd like to share with our audience?
Yeah, we have a couple new listings coming to market here soon. So make sure you go to storageexchange.com, check it out. And again, I just said we'd like to take deals to market, but we do about 60% of our deals on market and 40% off. So if you want to give us a call, anyone on our team can answer and kind of walk you through some of the stuff we have in the pocket that could be a good, interesting fit for you. But we'd love to talk to anyone, no matter where you are in your deal process, whether you're looking to buy, thinking of selling now or 10 years from now. We love the chance to just meet people and strategize. So thank you so much, Cindy.
Excellent. Again, thank you for being here, and thank you all for watching. We'll see you again next time.
Okay, take care.